Hi. So in this video, we will see the implication of investing in both way. Whether we should go on a simply month-wise approach or quarter-wise approach, or what happens in different scenarios if we go and invest lump sum. So it will be better if we go and do it through Excel sheet and try to understand what could be the implication. So let's say we have two scenario. Scenario one, where one person, let's say, make 1 lakh rupees per month and able to save 50,000 rupees, and out of which he decided to invest, let's say, 20,000 rupees per month. You know, so obviously I keep on telling you that investing into stock market is about creating a portfolio. I understand that, but for the simplicity sake, for the sake of understanding how it goes, we will just consider that there is only one stock in which we are going to put all this 20,000 rupees, and let's say that the stock price is 200 rupees. Well, if the stock price is 200 rupees and we have 20,000 rupees to invest, if I go and see the implication in 1 year, what will happen at different point of time is something we will calculate, right? Let's say when stock price is 200 rupees, Nifty is 12,000. Now when I say Nifty, I'm sure you have enough understanding about Nifty. So Nifty is this NSE website, the basic index of NSE or stock market, which is also going parallelly with BSE Sensex. All right. So we all know that market goes up and down, and in every situation, you have to keep investing because you have decided a SIP approach. So there could be a situation when market is down by 5% in the first month, then down by 3% in the second month, or for the sake of simplicity, let's say 5% only it is down. Then it recovered back and went plus 5% in the second month. So these kind of situation is there, that market is keep on coming, and well, your stock is directly positively correlated with Nifty. Positively correlated means if Nifty goes 1% up, it will also go 1% up. If Nifty comes down, it will also come down by 1%. 1%, yeah. So idea here is to understand one thing, that market risk is always there. If market is coming down, your stock will come down. Every stock will come down. That's why market is coming down. Yes, idea is also to beat the market. Means if market is coming down by 10%, we should invest into such companies which is only coming down by 1 or 2% or 3%, not by 10%. When market is moving up by 5%, our stock should go above 5%. Yes, that is the ultimate target of everyone, that they want to beat the market. If you don't want to beat the market, what is the alternate way? The alternate way is you simply go and invest through ETF, which is a passive investment. If you just want the return of market, which is also a good return, better than FD return if you see in the long term horizon, then yes, going into ETF will give you the return of the market. So when you go into stocks, you basically try to beat the market. That becomes your ultimate goal. Well, so market is moving, your stock prices will move as well. You have 20,000 rupees to invest. So let's say stock price came down to 190 rupees. Then it went up by 95 in the second month. Then it went to 210. Then again it came down to 185. Some crash happened. Then it went to even 170. Then it went to even 150. Then it started recovering and it went to 175. Then market is volatile, and you can see this kind of movement will be there for sure. Now what happens, that market went to 190, market comes down to, yeah, sorry, the stock price came down to 210, came up to 210, then it went to 230, it came down to 220, then it closed at, let's say, 225. Well, you started with 200, came to 225, and you see what is your return. If you would have just invested 1 month all the money, 12.5% would be the return. Here, what would be the situation? Well, if you have to invest 20,000 rupees, you will be able to accumulate certain number of stocks. What will be that? This divided by this. So 105 stocks you will get. So every month, why it is coming 0? We will see this. Right. So I should have written the formula before. So you can see the number of quantity is changing every month for you through all the market scenario. Market is volatile. We have seen that in past. It will be volatile in future also. And if you do it in SIP approach, this will be the implication, that you will have different number of quantity. Obviously, for one complete year, your salary will not increase. You will get the appraisal next year if you are in job, and you are a job person and you have decided about investing 20,000 rupees into only one stock. Obviously, this philosophy is not correct. You will not only invest into one stock, but at least a pool of 4, 5, 6, 7 stocks, depending on the what kind of fund size you have. Well, if we have taken it for the example, and then what we see, that we got a total of 1243 number of stocks. And when I see that 1243 number of stocks into the last month share price will be the total value which I'll be making. So what you can see here, that ideally, if you would have invested all your, how much money, 2.4 lakh rupees, this money would have become, with 12.5% return, 12.5% return with 2.4 lakh would have become, the number of quantity in 12 months would be 1200, since you would have been able to buy 1200 stocks, total number of quantity at a time. If you go lump sum approach, I can say that this is a per month approach. And now that you understand this part, I'll delete it, and here you will see that this is a lump sum approach. you know so in lump sum approach, your 2.4 lakh rupees would have become 1200 quantity into the last month price is 2 lakh 70,000 rupees, right? Your 1200 into 225 is, it should not come in percentage. Let's write here quantity into the price. So 2 lakh 70,000 rupees you would have made in a scenario like this. Trust me, whatever the scenario I tried to replicate you know the difference would be more or less same, whether you go and invest lump sum or you invest per month. In per month approach, you would have done little better in this scenario, and you would have made approximately 2 lakh. If I you know if I round off this number, you would have made 2,80,000 rupees. So probably here in this case scenario, you would have made 10,000 extra. But it is not the scenario that always a SIP approach will have a better case against lump sum. In some cases, you may find that lump sum is better also. But idea is, if you go and invest into different level, and if you start investing into a stock at 200 rupees, and if you see them coming down because market is also coming down, you do not have to get worried about it. You know, you have to just keep investing if you think that market is having a problem but not the company price is coming down because whole market is coming down. It is completely fine that you keep having the faith in the company and keep investing into the way you have decided. So in this way you have decided that you will go in a SIP approach and you will keep on accumulating. See, you can think it differently. You can think that okay, when the share price was 200 rupees, I was able to accumulate only 100 stock. It came down by 10 rupees, I am able to accumulate 105 stock. Here I was able to accumulate even 133 stocks. So you can see that with SIP, systematic investment plan, generally this SIP has been pitched in mutual funds, but you can create your own SIP also, and it will have a better risk management automatically, defined risk management automatically. What I mean to say, you will have better control over market emotions also, emotions of your emotions against market fluctuation as well. So yes, in many of the cases you will see that market risk is covered. Market risk means when market will come down, it will have an impact on the stock portfolio and it will help you. Right. When you have lump sum approach, in lump sum approach also, if your waiting period is good, you will actually have good returns. Meanwhile, you would keep on getting dividend also, right? So if you would have invested all 2.4 lakh rupees at a time, you would have got the dividend for the complete 1 year. And you would have thought that, okay, I got the dividend as well. And then I'm safely placed at 2,70,000 rupees with 12.5% return as well. Would have, made it a fair game for you also if you stick around for long term. But there is one issue in lump sum approach. What if you would needed money here at this point of time? When market is came down by 25% and you have this 1200 shares bought, it is came down at 1.150 rupees, you are in a loss of a good 60,000 rupees at this point of time. And let's say at this point of time only, you need money, you badly need money, and you have to liquidate all your stocks, then you have to have no choice but book a loss of 60,000 rupees and go home. Well, yes, this is a problem. People may need money any point of time. So now you will say that then what for people who have lump sum money and they want to invest and they also want to cover the market risk? Well, to give the answer, obviously this answer I'll give you in detail also on our future and option chapter. The main reason why future and option came into the existence was for the risk management, right? So in risk management, future contract options, we will learn how to manage market risk on a lump sum portfolio. Just to give you one hint, what you can basically do that for equal to Nifty future, you can create portfolio and you can short Nifty future. For people who already know future, they will be able to understand it. And if you are shorting Nifty future, you will be able to get premium and you will be also able to cover your portfolio or hedge your portfolio of 9-10 lakh rupees against the market risk. To hedge certain events, you can use put options also. So we will learn about this in detail, that what is the way you can go and hedge your overall portfolio if you are going to invest in a lump sum way into stock market. Obviously for that the total corpus needs to be anything above 8 to 9 lakh, considering Nifty is right now 12,000. So one Nifty will be 12,000 into 75. So if I go and multiply this, approximately 9,000, worth of portfolio is something which is required to cover, if I consider the beta of the whole portfolio as 1, very much positively correlated with Nifty performance or Nifty volatility. If we are able to create that kind of portfolio, we will I know I have used certain geeky terms like beta and all. You do not have to worry about. All I'm trying to tell you that yes, if you are not well aware about how to hedge bigger portfolio against the market risk, it is better to first start with SIP approach. You can see that in SIP approach, you will be able to protect your portfolio against market fluctuation and still come out as a winner into the market. If you have lump sum amount and still you have a clear cut indication that you would not need this money in near future, you can take even the lump sum approach. But if you are dicey that you may need some money in between, you may foresee certain scenario where you may need money, then it is better that you take the SIP approach only. Even if you have 2.4 lakh, you make a fixed deposit of 2.4 lakh. Every month you take out 20,000 rupees from there and keep investing into the market till the time you have spent enough time into the market and bought all the stocks at different level, right? So there is there are two approach, SIP approach and lump sum approach. Just to summarize this, SIP approach will help you manage the market risk, but this doesn't mean that you cannot manage the lump sum money in market risk. If your portfolio is above 9-10 lakh rupees, you can manage the market risk. Even in market fall, you will not make loss in short term on those portfolio. This is what we will learn in future and option class, that how to manage your risk of the portfolio, especially the market risk. But in lump sum approach, another note here is, if you have a situation coming in future and you foresee that you may need money, it is better advised that you go on a SIP approach and not take the lump sum approach. Otherwise you may come to a situation like this where you have to book loss and go home, and when market will come up, you will not get the opportunity to again go back and invest into those levels. So it is very important that you take these decisions based on the example I have shown you here. And you can create your own example, take the historical data from certain stocks, do some calculation and try to see what could have been better for you. Some people may also get panicked here at this level. They may think that this stock is going down, market is going down, it may go to even 100 rupees and they will lose more money, and just because of the behavioral finance also they may book a loss and go home. So in any case, a novice person, a person who is just coming into the market, according to me, it is better that first 3, 6 months, 1 year, you test the market with SIP approach. It is completely fine that till now you have not taken stock as an asset class into your portfolio. It is completely fine. If you would have not done in last 5 years, 10 years, it is also okay that you don't do it 1 year. Make sure that you go slow, because if you go slow you will do lesser mistakes, and if you don't do mistakes you will stay here for very very long term. Well, on this note, I'm closing this video, closing this dialogue on this chapter, and let's move to the next class.